Welcome to the Shut Up and Do It podcast, the place you can come and hang out with us while we go through all things real estate with a focus on bringing you top quality topics and speakers, all who believe in a get it done manner. I'm your host, Nick Allerud, creator of the complete deal flow system and a principal with AA Real Estate Group, along with my partner and co-host, the deal flow expert, sales trainer, the lead gen machine, the leader of the solutions group, the broker and the Esquire, Robbie Retzel. Hi, Rob.
Hey, yo. How's it going?
I am awesome, man. How are you?
I'm great. I'm really, really excited for today's podcast. I don't want to give anything away, but obviously we're very interested in cash flow, and that's what this guy basically does. And he's dominating. It's awesome to see him go all around the country, and just it's crazy how quickly he scaled his business and how different it is from where he started, I guess.
Absolutely. And without further ado, I'm going to let Matt just kind of jump right into his story. We're honored to have Matt. Oh, gosh, this is embarrassing. Picheny?
That's right.
Yes. I knew that. You can't say my last name, so we're even.
There you go.
That's true. That's true.
But no, Matt, we've sort of really just gotten to know you over the last several months, I would guess. But you've certainly come in with a force, hot and heavy in the Boston market here. So we're honored to have you. And if you want to start just by telling us a little bit about yourself, your story, where you came from.
Yeah, sure. Thanks, Nick. And thanks, Rob, for having me on the podcast. I'm really happy to be here. I've only been in Massachusetts for a little over a year now. Most recently, I was in Miami for the past 2 years. Prior to that, I was in New York City for 25 years. And I actually grew up in Orlando, Florida. I moved to New York to pursue a career in theater, which I did successfully for 5 years. I was a professional actor. And then I moved into, during the big .com days, I moved into a website development company that I created, a boutique agency working in New York City. After the .com bubble had burst, I went in-house. One of my clients was Showtime, the television channel. I went in-house there, worked there for several years, and then segued into working in the advertising industry in New York City. And I had a career in advertising for about 17 years doing digital marketing. And during that time, I started investing in real estate. And I started doing that very slowly, initially with a vacation rental property that I had purchased. And then I started getting more involved with single family homes and started growing from there. Fast forward to the time where we moved to Miami, my wife and I, she had a fantastic opportunity in Miami career-wise, so we moved down there. And that's when I really decided to take real estate full-time. And it became very clear very quickly that the way with my approach, I really wasn't able to see a place where I could scale it as quickly and as robustly as I was wanting to do in the single family sort of buy and hold or fix and flip model. But with multifamily, I found an opportunity to really scale up the kind of work that I was doing. And I was able to do that I had always wanted to get involved in larger projects, but I thought that you had to, have some wealthy benefactor or win the lottery to have the kind of capital that it would take to close on, a $10 million property. And I learned about a thing called syndication. And through syndication, a lot of investors can pool their money together, and you can work with one another to go ahead and acquire a larger property, which has allowed me to scale up to, I'm invested right now in over 1,200 units. And I was able to only do that by working as a member of several different teams at varying levels. Some of these apartments that I'm invested in, I'm just a limited partner and I don't really have a lot of say. Some of them I'm a principal in and I'm, steering the ship. So it's kind of like and even when I'm steering the ship, I have a co-captain with me, right? So it's definitely a team sport. And I like being able to work together as a part of a team to accomplish really goals that are maybe otherwise unattainable as a single person.
That's amazing. 1,200 units. That's not a mistake, right? Do you mean actually 1,200 units, like 1,200?
Yeah, a little over that. And by the end of next week, we should be closing on our latest acquisition, and I'll be over Yeah, it'll be 1,300 and some odd. I don't remember.
That's awesome. Yeah. Here's a question that I have. This is totally kind of, I wouldn't say it's off topic, but you're familiar with Joe Fairless, right?
Oh yeah, I know Joe.
Yeah. So he was also a marketing guy in New York as well.
Yeah.
Went to Texas Tech. What is it about the marketing guy, mentality here that leads you to, hundreds of millions of dollars in assets under control?
I really like Joe. He's a great guy. I've talked to him a couple times on the phone. The reason why is because, interestingly enough, Joe Fairless worked at one of the exact same agencies that I worked with, that I worked at in New York. Now, we were not both there at the same time, but we do know a lot of the same people. Yeah. Joe was a little bit more, as I understand it, on the client services, account services part of the business, which is a little bit more sort of on the marketing side, where the work that I did was more strategic and more project management based. I have a PMI certification. I'm a PMP is what they call it, a project management professional. And what I was really in charge of doing at the advertising agencies, beyond some strategy work, was making sure that projects were getting done on time and on budget and at the highest quality possible. So that is something that I think directly relates with the work that I'm doing in real estate, because I really am. I'm, at this point, when we take on a syndication, I'm in charge of, actually, finding the property, doing all the underwriting and analysis. But beyond that, it's really about, taking it from getting a contract to closing, which is and I would say a little bit more rigorous process than you would find in single family homes, with all the requirements from the lender. I mean, there's a bunch of additional work that needs to be done. So there's a lot of moving parts that you have to manage. And then after we close on the property, we do work always with a third-party property management company, but someone needs to be overseeing that and making sure things are getting done. So I'm able to sort of leverage my experience of doing that for 16 years, and that, the certification just, I think, helps show that I have tools and tricks up my sleeve that I can utilize to make sure that projects keep moving forward.
Sure.
Matt, is it for all of those tasks? You, by the way, you just dove right in, which is awesome. You brought us from A to W here in a matter of seconds. But when you decided to get into that multifamily because of that aha moment that you had, were you doing it on your own? And then, what's the evolution of, I want to do this, I'm going to get in there, and then how did you do it? Right? Yeah.
Oh, those are good questions. I guess I never was ever doing it all on my own, right? I think that in anything when it comes to real estate, there is always going to be some sort of team, whether that's, you're going to have an attorney who's helping you with things, or, a title agent, or, contractors, right? I mean, unless, you are, somebody who can do all the construction work, and you're an electrician and a plumber and you have a law degree. I don't know anyone who has all of those skill sets. Some people, a lot of times you might find someone with a couple of those. So I think it's always about building a team. And that's just what I've continued to do. I got started in multifamily as a limited partner in a number of deals where I, was just kind of a fly on the wall. Luckily I had a little bit of capital that I could put up front to get involved in these projects and see the returns, but also watch the project and see how it's evolving. And that's where I really started to learn a lot of the more intricate details. And the people that I would invest with, I would let them know, like, hey, I want to be able to hop on the call with you and have conversations and learn about what you're doing. And I've learned a lot through, as you put these projects together, you try to plan for everything that you think could go wrong, right? But inevitably, there's going to be different things. There's going to be challenges that you're faced with. And it's really about how do you overcome those challenges, and then you learn from those. So what I'm able to do is leverage the other people's experience through being a partner in a deal with them, but not necessarily something that I've acquired or that I've led. And I continue to do that to this day. I mean, 25% of my portfolio are projects that I'm the leader on, but 75% are projects that I'm passively invested in. And that doesn't necessarily only mean real estate. I mean, I also invest in some other projects as well. And I do that passively. And, it's I think, a great way to learn.
That's awesome.
Yeah, absolutely.
When you go from, so your team is where really, as you mentioned, you started, you can't do it alone. You need the attorney, you need the financing professional, you need the commercial brokers in the area, the third-party management companies, right?
Yeah.
Did you ever get to a point, and maybe you're still, do on your projects that you're GP on?
Yeah.
Do you actually still fill all the roles as far as finding the deal, raising the funds, doing due diligence, bringing it to closing, and then managing? Or do you have like different people that are on your team now? I guess internal team.
Sure. When it comes to the acquisition, at this point in time, I'm the only person I'm usually the person who's going out and finding the deal. Or I should say, sort of directing the team. So the way that I work, I want to give you an example. This deal that we're about to close in Kansas, right? So it's in Kansas City, excuse me, just outside of Kansas City. And the way that I found that property was by spending a lot of time in that market and developing relationships with brokers and with property managers. Taking a look at a lot of deals, analyzing a lot of them. Most of them don't make sense. When I get to the point where I'm ready to go ahead and put an offer in on a property, I work with a property management company that I met there. Now, I spent a lot of time in that market. I interviewed a lot of different property managers. There was one company in particular that I felt very good about. They had a stellar reputation. They've been managing properties in the area since the 1980s. So, they have a lot of experience. They have a very robust team of people that they've worked with, lots of deep relationships and contacts in the different specialty areas within the field there. And, when I get to the point where I'm about ready to make an offer, a lot of times I'm reviewing my underwriting with a property management company to make sure, hey, do these expenses look in line? What do you think about the taxes? How about insurance? And have that sort of dialogue, especially with someone in a market that I don't have a large presence in. And, through doing that over the past year or so, we were looking at a number of deals, and during one of those conversations with the property manager, they tipped me off to the fact that they had a property that they were managing that the owners were getting ready to sell. So that's how I sort of got my foot in the door there. So, did I find that property all on my own? Well, not really. I mean, I was told about the property, but then I did all the work, right. But that's what I'm saying. So had I not had that project management company as part of my team, then, that never would have happened. Never would have happened in a million years. I wouldn't have been aware of it. So, that's why I think multifamily is really a team sport, and it's about, creating those relationships, because that's where all the good deal flow comes from, in my experience. I mean, you can find things off of LoopNet. I know a guy who found an awesome deal in Texas off of LoopNet, and they just sold it. They made a killing. They did a great job. The thing had been on LoopNet for like 2 years. There was a lot of problems with it, and it took the person who was doing it a lot of work with it. It was a small mom and pop property that had been owned, and they didn't have really strong financial records, so he also had a hard time getting the financing. But I mean, it was a home run when all was said and done, but there was a lot of work that was involved in it. And there's many ways to get deals, but I think those relationships are really key.
Absolutely. Yeah. So do you want to go a little bit into, when you're looking at deals, when you're underwriting deals, what sort of deals are you looking for? Are you doing massive repositionings, or is it kind of a little bit smaller value add type stuff?
Yeah, that's a great question, Rob. So I'm looking for B and C class properties. I think that A-class properties are great for sort of preservation of capital, which is sort of the way that I feel about the Boston market, especially inside the 128 loop. I mean, Boston is an awesome market, really diverse economic drivers from many different industries. It's a fantastic place to be in, but I'm not seeing, at least inside the greater Boston area, the kind of returns that I'm finding in other locations. And what I'm looking for is B or C class properties. So as an example, the properties that I'm acquiring right now in Kansas, they were built in the 80s. They were owned by the developer who built them. And then about 12 years ago, he sold them to the current ownership. The original owner and the current ownership really haven't done a heck of a lot to upgrade the property. I mean, there's not like a ton of deferred maintenance, but the units look dated. And that presents a great opportunity because the prices of those, the rental prices for the units are well below the current market. So when you drive around the area and you look at other apartment buildings, they're charging more for the same square footage, but they look nicer interior and on the exterior. So what we're doing is we're going in there with fresh capital and we're making updates to the interiors of the units. And, look, this is B, C class properties, right? So we're talking about working family, blue collar. We're not putting in granite countertops, right? We're refinishing countertops. We are doing stainless appliance packages on one. It's a portfolio of 2 properties. So we're doing stainless on one of them because it works there, but we're not, making the Taj Mahal here, but we're taking in one of the properties. There's like an old dilapidated tennis court that's just falling apart. Nobody even used it when it was working. It's just not a big tennis community. It's a lot of families there. So what are we doing? We're going to take out that tennis court. We're going to put in a playground because there's a lot of kids. And we're also going to put in a little bark park, right? A dog run, because a lot of the people who live there, about 75% of the units in that community have a dog. So these are amenities that the people who live there are going to love to have. And we're just going to increase the quality of life and like you're saying, sort of do a repositioning on it. When I look at the market as a whole, especially right now, a lot of people say that, we're at the top of the market. We're almost at the top of the market. We're starting to come down off the top of the market. But I don't hear anybody saying we're at the bottom of the market right now. I mean, I think the consensus is, look, we're at or near the top. And so where are we going to be? My strategy on these properties is to hold them for about 5 years. Mm-hmm. And the way that I'm doing my underwriting, I'm saying, okay, 5 years from now, I actually think the value of properties in general, of housing in general, is going to be less, because I think prices are really high right now. So probably the most important component of projects that I'm looking at in this current day and time is there a strong enough value add component there where I can force appreciation? Because I don't think we're going to have that natural appreciation that we've experienced over the past 10 years, which has been fantastic for everybody in real estate. But I think values are going to stagnate or most likely go down. So what can I do to force that appreciation? And when it comes to multifamily, it's done a little bit differently than residential. Residential properties are valued based on the comps, right? What are comparison sales in that area? When it comes to multifamily, it's a mathematical formula. It's your net operating income divided by your cap rate. That equals your value. And everybody in the world that I know, every investor that I know does it that way. Every book, every podcast. I took courses at Boston University. That's how they teach it there. It's the way that it's done. So if you can increase that net operating income, which is, your rental income minus your expenses, if you can increase that NOI, you're going to force appreciation. And that's sort of the name of the game.
That's awesome. When I learned once too, an interesting lesson where, right, if you increase $1 of income, that's still not worth as much as decreasing $1 in expenses, right? Because for every $1 of income, typically your expenses kind of also go up. There's a ratio there, right? Would you agree?
Well, I think it depends on the kind of income that you're increasing, right? But I think, yes, that can happen. There are ways to increase income with no expense. And that's kind of one of the things that we're trying to do. Apologize for that.
That's okay.
That's one of the things that we're trying to do is figure out ways, what can we do that's going to cost us nothing or close to nothing but increase our net operating income. One of the ways to do that is with parking spaces, right? So let's say, we're not going to be doing it this way on these properties that I'm acquiring right now, but I know a lot of people who've done this very successfully. It depends on the property and the layout, right? But where they were able to create reserved parking spaces. So all it really costs is the cost to paint some numbers on each parking spot, right? And then you start charging people $5, $10, $15 a month for that reserve parking, which might be in a better location. And that there's no additional expense for that, but you're increasing your net operating income. There's also things you can do, like, as an example, if you were in we've done this on a couple of the properties that I have, where it's an all bills paid type of property. So somebody is paying their rent, and then they're paying maybe $35 a month or whatever the package might be, and that includes their electricity and their water and all bills paid. You can go in and do like a water conservation program. Or you can go in and do something with the lighting, get rid of all those incandescent bulbs and switch them out for LEDs. And when you're doing that over 100 to 200 units, you start conserving the water. You have the new toilets that have low water flush rates. You're using less water, and again, the LED lights. Over time, that's actually decreasing your expenses quite a lot. So the bottom line is, what's that net operating income? So any way that you can do that, whether it's increasing income or decreasing expenses, or hopefully both, really helps add value to the property. The other thing that's really interesting about that thing that I just talked about with the water conservation and the LEDs, is you can, depending on what kind of financing you're getting, Fannie Mae has a green program. They will give you a lower interest rate if you are going to go ahead and implement some of those types of changes on your property. So you're doing a great thing for the environment. You're doing a great thing for your bottom line, and you're getting a lower interest rate. So it's pretty fantastic.
That is incredible.
Yeah.
Is there any case studies you might want to have, Matt? Here's maybe a good question. What about like a lesson learned? Did every deal go exactly the way you wanted it to go?
Yeah. No. Not every deal goes exactly as planned. And, that's part of it. And, I think the question really is, when you're working with somebody, whether you're looking for something to invest in on your own, or you're looking for a partner to work with on a project, it's really, how do people, face those challenges? Do they just, get hit over the head and walk away and go home from the game? Or do they, brush themselves back up again and go right at it again? I mean, I have fortunately never had like a complete bust where I've had like a foreclosure on a property. I have had, especially when it came to the single families, especially when I was doing flips, I had some deals where I break even, I'd lose a couple of bucks. Luckily, I'd have something else that I was doing where I'd make a profit. So it all sort of balanced out in the end. But I think, you're constantly coming up against different challenges. Sometimes you underestimate a market. One of the projects I'm involved in right now, it's not going as well as planned. I'm a limited partner in the deal. I don't have a lot of say in the exact operations, but I think there were some miscalculations that happened in terms of the type of rent growth that we were going to get in the market, and the type of population growth. And I think that we felt that the neighborhood was a little more towards an A-class neighborhood, which really a little more towards a B-class. I think at the beginning, we over-improved the units a little too much. And so we spent a little bit more, where now we're spending less and still getting the same rents. So, we over-improved a little bit. And that happens, especially when you're in a new market. But Overall, does it mean that we've lost money? No. Does it mean that we're not getting the returns that we projected? Yes, we're not. But then we have other projects where we're getting, 10 times more than we had anticipated as well. So, I think part of it is not putting all of your eggs in one basket. You don't want to spread yourself too thin, but I think that if you, especially as I'm talking right now solely as a limited partner investor, I specifically try to invest in different markets with different owner operators. And now ones that owner operators have shown me that they do a good job, I then put more money into their projects too. But I like having a diverse, diverse investment portfolio. When you look at the locations, I have properties in New Mexico, all over Texas, Atlanta, and Florida. And so, we're talking about, and soon to be Kansas. So we're talking about a bunch of different markets that have different ups and downs. I don't want to put all my eggs in one basket. When you look at Worcester, which is doing great right now, but they had a big, there were a lot of industry, right, and manufacturing, and that went away. And that town experienced a massive, massive downturn. Now they're back on the upswing, but I just don't. I never want to concentrate all of everything that I have in one particular marketplace, because that marketplace will experience ups and downs over time.
That's interesting. So you're diversifying geographically as well as through different operators in kind of different markets, and then obviously doing your own GP deals as well.
Yeah, and different plays. Some of these are yield plays. Some of these are value add plays. I like the value adds a little better. And some of them, it's like, look, this is a C-class property, or, hey, this is a B-plus property, So I think that, plays differently as well, depending on where you think we are in the cycle. As we start to go down a cycle, traditionally what you'll see is the A properties getting squeezed. B's tend to be okay, and C's tend to do better. I haven't done any mobile home parks, but they are cash cows. I know a number of people have invested in them, and during a recession, those do unbelievably well because everything's getting pushed down, and there's a lot of demand that gets built around there.
Mm-hmm. I think it was Kevin Bupp. I heard him on a podcast. Who's a huge mobile home investor, and he said, as essentially, when the recession hits, it's recession proof, because if you can't afford a mobile home, you're living under a bridge.
Yeah.
So interesting. Talking about underwriting, how do you choose a market? What are the factors that you tend to go after when you're doing that?
Yeah. The way that I've done it, I think there are certain markets that are just super strong, right? When you look at Dallas, when you look at Central Florida, they're really strong. And right now, I think there's too much competition in those areas right now. People find deals there. You can find deals anywhere. But I'm looking at other markets right now and trying to find markets where you've got nice growth, where there's particular submarkets that are doing really well. And when I'm looking at those markets, I'm looking at what's driving the economy there. Do they have jobs? Do they have job growth? What's the potential for future growth? Is it a business-friendly state and a landlord-friendly state? Is it a business-friendly town? Do they have a lot of these cities will have like an economic development council or a chamber of commerce. And I like to see population growth, and I like to see employment growth. Employment growth is really the leading indicator, right? Because if there's jobs, that's where people are moving to. And that's why I think, the DFW area in Texas is doing so well, and the Orlando and Central Florida is doing so well, because you've got, the states and the local cities there doing everything they can to bring employers there. The cost of living is less there. So it allows those corporations to be able to bring in really good talent, and that talent can live a really nice quality of life where, you're spending in terms of buying a home, right? You're looking at, I don't know, $800,000 for a nice home in Massachusetts, where you can get the same thing for like $200K in Texas. And like, that's a massive difference. So you could therefore pay your employees a little bit less, and they can have a nicer quality of life. So it's really about that growth factor. Do we see growth? And it doesn't need to be crazy. This deal that I'm doing right now in Kansas, we're seeing between 1% to 2% population growth. But that's been sustained for like the past 200 years. And it's projected to continue doing that for, the foreseeable future. So when you have, that's one of the things I like about sort of the center of the United States, is you've got more of a slow and steady, kind of like the tortoise and the hare, where your markets on the coast will tend to go incredibly high during boom times, but they can also crash pretty hard. So yeah.
Oh, that's crazy.
That's awesome.
Do you want to? We've got a few minutes left. Do you want to go over that deal in Kansas? Are you for people either on this podcast or in general, or are you done raising for that? Are you?
Well, I'm done raising for that.
Nice.
And I couldn't even advertise about it if I wanted to, if I was still raising.
That's right. No returns allowed on this podcast. We were just curious on the deal itself, right?
Yeah. There's a SEC rule that doesn't allow syndicators, the way that I'm doing this on a 506B, I can't like advertise for the property. But I mean, I can tell you that, we're really excited. We should be closing next week. It's fully funded, as I mentioned. And, it follows the model for all my deals. All of the deals that I'm looking for a 5-year hold. And in that 5 years, I'm looking to, between 5 to 6 years. It's a little more competitive today. So like on this deal, it takes almost 6 years to double your money. So I'm looking to double investors' money in 5 to 6 years. But during that hold time, you're looking at double-digit cash-on-cash returns. This one's going to be close to 12% average annualized cash-on-cash. So while you're holding on to this property, you're getting that return. And I'm doing 12-year Fannie Mae financing on this property. So what that allows us to do is have a little bit of flexibility, because 5 years from now, let's say we're at the bottom of the real estate market cycle, right? That would probably not be the most opportune time to sell the property. So we'll have another 7 years there where we can wait for the market to get back up to where we want it to be, to go ahead and sell it. And if we're in that sort of situation, we'll still be getting double-digit cash-on-cash returns, where most of our other investments, people, if we have money invested in the stock market, that's probably going to be like really, really in the toilet. So to have a investment that you have that is still giving those cash-on-cash returns doesn't matter. That's why I'm a big proponent of cash flow investing and long-term investing, because when it comes to real estate, it really doesn't matter what the value of your property is. There's only 2 times that matter, right? One is when you buy it, and number 2 is when you sell it. So as long as you're holding on to that and you're producing cash flow, you've got a great investment there. If you never have to sell it, you'll never lose money.
Absolutely.
Amen, brother.
The other thing that's really interesting that really intrigues people who are real estate investors, especially more on the single family perspective, is when they start to hear about the tax benefits that you can get from multifamily. And a lot of that is done by a thing called cost segregation, which can be done on single family homes, but it's not always necessarily the most cost effective. For an example, you can do a cost segregation study on a 100 unit property for maybe around $5,000 or $6,000, which on a $10 million property, it's kind of a drop in the bucket. There's still a lot of that work that would need to be done on a single family home. So you're not getting those efficiencies of scale. But for those who don't know what a cost segregation study is you have an engineering firm come in and they do an analysis of everything in the property. So a residential property, you can depreciate off of your taxes over 27 and a half years. That's just the value of the building. You're not allowed to depreciate land. But if you do a cost segregation study, this engineering firms can come in and tell you, well, listen, this computer will depreciate over 5 years, and this piece of furniture depreciates over 10 years. And there's different regulations with the IRS and guidelines that they follow, and they can accelerate your depreciation, especially within those first 5 years. The real kicker is with this new tax laws that Congress just passed that go into effect this year, there's a thing called bonus depreciation, which you can take advantage of. Now, bonus depreciation has been around for a while. It used to only be for new properties, new construction, and now it'll work on any property acquired after September 2017. So it allows you to take that depreciation, anything that's cost segregated that would depreciate in 20 years or less, and you can depreciate the entire thing in year one.
Yep.
Yeah, crazy.
So you can see 75 to 80% of your initial investment as a tax loss, on paper in year one, even though you've gotten cash flow. So that, it depends. I just want to caveat this all saying I am not your CPA. You need to talk with your CPA. There's passive loss rules. There's a lot of things. But for people that are positioned in the right way, you can see some massive tax savings.
Take that. All I have to say is we have maybe 1 minute left. But hey, listen, take that, National Gurus. You got the entire system in 35 minutes. So, holy cow. Hey, Matt, how can people reach you if they want to get in touch with you?
Yeah, go to my website, mjppg.com, or you can email me, Matt, M-A-T-T, at mjppg.com. My website, there's a newsletter you can sign up for, or feel free to email me. I love talking with people about real estate.
Well, Matt, this was awesome. Thank you so much.
Well, guys, thanks for having me. I really appreciate it. I think you two guys are doing some awesome things, and you really are out there. I think just being really successful in real estate in the Massachusetts market between this podcast that you have and your meetups. And I think it's great that you guys are sort of helping people have careers in real estate as well through your coaching, your tutelage. And I think that's fantastic.
Oh, thanks, Matt. We're here shutting up and doing it. Thank you all so much for listening, and we'll see you on the next one.